Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to Cut to the Chase. Now today is World Meteorology Day and that holds special significance for me because if there's one thing that can be as hard or harder than predicting markets, that is predicting the weather. Now, I've acknowledged that weather forecasting has made great strides. As I learned from my son's school project, meteorologists are much better at predicting weather over short rather than long horizons. Quite the opposite of market forecasting, but don't let that take away from how difficult and important the job of weather forecasting is. Now, staying on the topic of difficult forecasting, today I want to talk about the bond market. At the start of this week, we pointed out that Fed policy speeches every day of this week could end up being a key driver for markets. On this front, Fed Chair Powell certainly stole the headlines with his speech on Monday, US time. Speaking to the US National Associations for Business Economics, Powell said the US labor market looked extremely tight and that inflation was much too high. Now, he said there was a need to move expeditiously to return monetary policy to a more neutral level or even restrictive levels if that was needed to restore price stability. Now, I would note there is a range of views at the Fed. So Bostic, who heads the Atlanta Fed, said he supported just 5 rate hikes this year, while on the other hand, Bullard, who heads the St. Louis Fed, said he supported raising Fed rates all the way to 3% this year, which would imply several 50 basis point rate hikes. Powell's view as chair, though, do carry some influence. Now, why does this matter to us as investors? Recall that US bond yields are a key variable because they're the baseline from which all US dollar denominated bonds are priced. They often have a strong correlation with several non-US government bond yields, and they're also often one benchmark from which to consider equity market valuations. So quite an important market variable. Now, after Powell's comments, the 10-year US Treasury yield rose to almost 2.4% at one point, taking this month's rise in the 10-year yield to well over 50 basis points, the largest since late 2016. The picture was even more stark at the shorter end, where the 2-year yield has now risen over 70 basis points month to date, the largest monthly rise so far since 2004. Now, what do investors do with this and in terms of interpretation and market action? First is that rising bond yields are likely to worry some equity investors about whether they'd hold the market back. From our point of view, we'd worry less about this for now because policy and yields remain far from restrictive given where inflation is. For now, we believe the focus should be on what looks like an emerging equity market rebound. And second is that in the coming days, the question will undoubtedly come up whether the rise in yields is creating an opportunity to add exposure to longer maturity bonds now that yields have gone up. Now, there could be some selective merit in this argument, but this is something we'll come back to in our end-of-week podcast and monthly publication. So please do keep a lookout for that. And finally, in FX markets, what this means is that we maintain a focus on currencies where their own interest rate and bond yields are rising as well. Now, preference for commodity currencies fits very neatly into this bucket, like the Canadian dollar we talked about yesterday. However, it does suggest some caution when it comes to the Japanese yen. Now, the widening yield gap between the US and Japan should keep the yen under pressure. The Bank of Japan remains possibly one of the few central banks keeping policy unchanged. However, the size of the move in the dollar-yen pair means that it's now very overbought. So that means there's a risk of a very sharp snapback, especially if risk aversion rises for any reason. So we'll be a little bit careful over there. So big moves in the bond markets, but some very different implications across equities, bonds and FX. We'll pause there to go ensure we listen into the next Fed speaker. But if you enjoyed this podcast, please don't forget to rate and like it. Thanks again for listening. We wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.